We're joined by Dineo Mbahlele. Dineo is with the PPRA, heading up the Inspection and Investigations Department, also the PPRA representative and coordinator for FIC compliance-related matters. It's really nice to have you today. But again, people are working in a regulatory environment. There's a lot more regulation. Just give me a sense of where we are, please, from a PPRA perspective in terms of the regulatory framework.
Okay, thank you, Bruce, for the opportunity. You'll note that the PPA, the Property Practitioners Act, came into effect last year. It's actually over a year now. We had the Estate Agency Affairs Act that was governing the real estate environment. But what has happened now with the PPA is that it has expanded the property practitioner definition, meaning that it includes various role players which were previously not there. So it includes, for example, auctioneers, property brokers, estate agents are still there as well, managing agents, bond and originators, and various other role players. The reason being that I think the Act as it stands now is more around protection of the consumers. So to ensure that consumers are really protected, the legislator, I think, was looking at the fact that how do we strengthen the protection of the consumers? How do we promote the interests of the consumers? And how do we look at the value chain in terms of property transactions? And that's where now it decided in terms of who are those regulators, maybe, for example, who are not regulated elsewhere. So that is where we look at expanding the definition of a property practitioner, mainly just to regulate those are not regulated, and also to strengthen the protection of consumers.
All right. Let's get into some specific questions. Are property managers allowed to charge an admin fee if agreed in their contract for the notice sending for non-payment? That's one very specific question. Somebody doesn't pay, you send a notice. Can you charge for sending that notice?
Yeah, I think from that point of view, where the parties agree, I think that is the question. Where the parties agree that the fee may be paid, yes, a fee can be charged. But we must be also it's very important also to note that when you sign a contract with a client, one of our code of conduct, one of the regulation is that the contract must be clearly explained to the other party so that they are aware that there will be a fee that will be levied against them. And they would have agreed with the knowing that that is part of the agreement. They may, but we also say that there's a PPRA that let's look at the code of conduct, what is provided there. Let's comply with the requirements of that code of conduct. And also you may need to comply with the requirements of the law, especially the law, because you may find that different types of leases exist. There may be a lease in terms of leasing a business. There may be a lease for residential purposes. So there are different legal requirements as well. So you have to take note of those.
And just make sure it's in the contract. I mean, if you have that agreement, make sure it's in the contract. If it's in the contract, then nobody can claim that it's sort of a last-minute addition. I don't understand this question. I'm not in the property industry, but it comes from Mark Lunau, who's just asked this particular question. And it says, I just asked the PPRA why one cannot do more than a minimum of 15 verifiable points / 3 modules voluntarily, almost without expecting more points, but the answer was disappointing and not in line with objectives to grow agents' knowledge. Do you understand the context of the question? Because this is about making sure that the practitioners are up to speed, and they've got to be incentivized to be up to speed. That's my interpretation of this question, that there are not enough incentives within the regulation to encourage people to actually do the work.
Yeah, there is those prescribed CPD requirements where you have to do about 15. I think now it has been reduced because basically it's provided for in the regulation. We are actually implementing what the regulation is saying. It says at least a minimum of 6. So if a person wants to go and above that, that will probably be non-verifiable. And I think they should be allowed to do that. But what is prescribed by the regulation is that you have to comply with those 6 that have been provided for.
Okay, let's move on to the clarification on the changes to Regulation 34. It introduced some changes in the way interest can be earned in trust accounts and how that interest is handled. Can you explain that, please?
Yeah, that is a very contentious issue. maybe I can start off from the previous legislation. Previously, we have Section 32(1), where it provides that estate agent at the time that they have to open a trust account and the money that they received must be paid into that account. And we now have Section 54(1). Section 54(1) is more or less similar, but the difference with that one, it says that the interest that is earned is payable to the PPRA, meaning to the Fidelity Fund. Initially, what used to happen with the previous legislation was that there was a 50% split between the PPRA or the estate agency affairs board, as well as the estate agent at the time or the property practitioner. So that provision, that kind of incentives has been taken away.
Why?
We have, by the legislature, is actually in the regulation.
Yeah, I know it's in the regulation, but why was it done? What was the thinking behind the change?
The thinking, Bruce, behind the change is that all the money, I think they wanted to maybe equate with the attorneys. The attorneys, what has happened is that the 100% is actually paid to the Fidelity Fund. So that is probably the thinking behind it. But what the PPRA is looking for and what we have heard from the industry body is that they want that previous regime to be reinstated. And that is what we are working on with the regulation. What we have now embarked on is to have the regulations amended. We have commenced with that process. We know that it's a parliamentary process, which means that we are receiving inputs internally. We are dealing with that internally. And as far as the internal engagement has been exhausted, we're actually going to engage with the industry as well as the public in terms of public consultation. And thereafter, we know that we'll have to give it to the board and the board will forward it to the ministry. And then those parliamentary process in terms of amendments will follow. I think that is the status quo that we wanted to keep together with, in support with the industry out there. And that is what we're aiming to have.
Okay, cool. Thank you. Nice for clarification on that one. You are heading up the inspection and investigations department. It must be the most exciting part, I think, of the entire regulatory framework. But there's been quite a lot of change when it comes to the PPA. And I think we need, again, a little bit more clarification and maybe some practicality. What are the key elements that your department would like to review to ensure everyone's compliant, to ensure that when you inspected, that everything is tip-top?
Yeah, I think because of the PPA is quite new. We went out on public consultation to tell them the scope of inspection in terms of the new legislation. So briefly, what we're looking at, we are testing that the person has the valid Fidelity Fund certificate. We are testing as well that they keep accounting records. You remember, they have to keep their accounting records and balance them on a monthly basis. So we have to check that, are you keeping those records? Are you also balancing your documents? You also have to check that the trust monies, which is quite important for the PPRA, that is actually paid into the trust account, and the trust account is correctly designated, that you have opened a trust account. And in terms of, you will also know that we do FIC as well, FIC inspections. Those FIC inspections, we have to look at in terms of whether are we compliant in terms of reporting. So we look at whether property practitioners are reporting suspicious transactions, are they reporting cash transactions, and also are they keeping records? And also one other important thing is that when you do customer due diligence, are you scrutinizing the information that you receive? Remember, as a property practitioner, the property environment is actually vulnerable for money laundering. So we have to make sure that the monies that we receive in our businesses, those are monies that are legitimate and that are not being used for money laundering purposes. So it's quite important that when property practitioners prepare for us as we come, make sure that you have FIC requirements that are compliant, you have PPA requirements that are compliant, you have your current Fidelity Fund certificate, your certificate is actually displayed where is really prominent for the for the purpose of the consumer, that you can see that you are very compliant amongst those things that we do need. We also look at the contracts. It's important now that the contract is signed by both parties. And there's one additional requirement that has also been placed on the property practitioner as well, is to ensure that they have signed a mandatory disclosure form that is forms part of their contract.
Okay, critical. Johan, I see you in the discussion as well. I mean, do you want to add into this conversation on regulation, the clarity that regulation brings, where there may be gaps that need clarification?
Yeah, first of all, thank you for the opportunity, and then thank you for Denio to taking part of this. I want to go back to that contentious topic with regards to the trust accounts and interest. And maybe, Denio, first of all, the explanation provided is fantastic. It's great to hear that there is a possibility of potentially reverting back to the 50% split on the interest earned. But I think maybe just clarification on the two types of interest, the incidental interest and allocatable interest, because there's obviously two types of the two different trust accounts. If you don't mind just shedding light for the audience on those two trust accounts and the type of interest earned with regards to the split that might be coming to effect again.
Okay, thanks, Johan. Let me start with the section 54.2. This is the interest now that has been earned where now a client has indicated that the money must be invested. So you have an express mandate from the client to say the money must be invested. That one is clear. Obviously, you have a mandate from the client, then the money will definitely, the interest will have to go to the client. Then there is this one that when you open a trust account, immediately the money is not really invested, but it may be used probably at a later stage, but it still remains in that trust account. That is the interest that you are talking about. That is the incidental interest. That is the interest where now it has to be paid into the fidelity fund. And that is the interest that you want the legislature or the ministry to look into, because the 100% thereof is actually going to go to the fidelity fund. And that is the issue that was brought to our attention to say there is no incentives for a business property practitioner now to receive that 50%, because initially they have been receiving that. And the likelihood that we see happening is that the property practitioner can easily request or inform the client or the consumer to say, if you don't have an express mandate, know that this money, the interest that is going to accumulate here, the 100% thereof is going to go to the fidelity fund. Therefore, there is no incentives for the property practitioner, and at the other side, there's also no incentives for the fidelity fund. So the previous regime really worked well for both the property practitioner as well as the fidelity fund.
That's fantastic news. I think we look forward to the outcome of this journey. Yeah.
Okay,
Yes.
thanks, Johan. Thanks, Deneo. Another question that needs a little bit of contextualization, and it comes from Mia Akat saying, please may I have some clarity, very polite, around firms applying for exemption to not have a trust account, but using systems like WeconnectU RAMs for holding rental deposits.
Maybe I can shed some light on that. So, Bruce,
Okay.
it's quite clear that if you are receiving and holding trust monies, that you must get audited. The ecosystem with WeconnectU is that all clients have the trust account 54.1 and 54.2 in their name, in the entity name. That means all clients will go through an annual audit. That I think it's a great opportunity to have an independent review over, which is obviously a very high-risk environment. A great benefit for clients on WeconnectU, they can have a complete online audit. So I think Skalk after this session will shed some light on some of the reporting available. But the reality is, if you provide your auditor with an online login, they can literally conduct the whole audit online with all source documentation being retrieved from WeconnectU. So it's a critical compliance aspect, the annual audit. And I think the most important thing that technology should do is to really make this as seamless as possible for the auditors as well as the property managers when they're conducting these annual audits.
Johan, thank you very much. Deneo, if you've got nothing to add or a final comment.
Well, the final comment is just to say thank you for the platform, and we're looking forward for more engagement with the sector because this is what we need to do. Consultations are very important. Collaboration and engagements are very important for the PPRA, so that we know what the problems are, the challenges are, so that we can jointly maybe try to resolve it. Thank you so much.
You know, Mpahlele, thank you very much indeed from the PPRA, and also for your contributions this morning, Johan. Thanks very much indeed.